All right, we have to talk about, should you be a passive or an active investor? And that's a big topic that I really want to dive into, especially in times like now where there's a lot of volatility. It can make you second guess your investment strategy. So let's dive into these two approaches, the pros and the cons. We'll actually look at people who've been very successful at doing both. And at the end of the video, I'll share what I've been doing. I'll actually dive into my 2021 performance and let you all see what that looks like. And we'll go from there. All right, let's get started. All right, so welcome back. This is Joshua Talks Money. So glad you found my channel. I talk about everything personal finance, mostly because I built and sold a tech company and now I really focus on learning about investing. I'm trying to share the lessons that I've learned and the ones I'm still learning directly with you. If that sounds interesting, please consider subscribing. Please hit the like button and share this video with someone you think could find it helpful. Also, if you do not own Bitcoin, but you've wanted to explore that, there is a link in the description of this video. Sign up for Coinbase. You will get free Bitcoin for joining, and it is something I don't think you will regret. All right, so active versus passive investing. It's really this age-old question of which approach is better. And let's first start off with a few definitions. All right, so active investing. This is effectively when your money is in a fund with a person who's actively making decisions to buy and sell and hold investments to achieve some desired outcome. And this is really an attractive concept. And if you think about the pros of this approach, well, I like to think of these fund managers as these brilliant, very well educated people who know far more about finance than you or I ever could. And they're using things we don't have. They're using things like really specific data. They have financial tools and financial modeling and algorithms that we could never access. They have analysts and people whose lives work is basically studying certain sectors and understanding how the market moves in different conditions. And then they're able to take all of that information and make wise, informed, financially sound decisions to grow your money. I'd also say the idea of actively managing your investments is really glamorized in our culture, from things like HBO's Billions. And then there's these celebrity investors like Cathie Wood. She had burst onto the scene in all this prominence because of her performance picking stock. And someone like Bill Ackman, this guy's a legendary investor, very controversial at times, but very outspoken and also looked up to for his knowledge and his experience. Now, I'm here in South Florida, and this happens to be a place where a lot of these hedge fund billionaires like to either live permanently throughout the year, or they have their $100 million beach homes. And so I'm actually quite often around this type of investor and seeing the wealth and seeing the success that they have. And I always have to think, they didn't get that way because they just bought the S&P 500, right? So there is some success and significant upside to be had if you do indeed pick and actively find ways to grow your wealth at a much faster rate. But can you do that? And could some other fund that you give your money to do that with any consistency at all? And that's the key to this whole conversation. Yes, what if you beat the market in 2020? What if you beat the market in 2015? Fantastic. But could you beat the market from 2000 to 2022? Could you do that every year with consistency? And the answer is a resounding no. It is very, very unlikely that you would beat the market every year. And that only exposes you to more risk. All right, so let's talk about someone like Peter Lynch, who recently said that passive investing would be a mistake. And I think that conviction comes from the fact that, one, he has been very, very successful in the active investing approach. He ran the Fidelity Magellan Fund, and he brought that from $14 million to $18 billion. Just truly incredible, incredible gains. And he did that by buying, I believe, thousands of companies and was really active in looking at different markets and different places to put capital. So with a track record like that, and perhaps that it was easy for him, of course he would advocate that that's the best approach. But it is not easy for the average person to do what Peter Lynch has done. Otherwise, we would all be very wealthy. And if we take a closer look at how hedge funds have actually performed, the HFR, this basically tracks global hedge fund performance in kind of an index through data analysis. They show that in 2021, the return on average for hedge funds was 12%, which is pretty good. It's pretty good until you look at the S&P 500's return, which is almost 26.9%. That's pretty significant. So meaning all the things I've described earlier, all that knowledge and data and the resources and the capital, and you still perform half of what you would have if you left it alone in an S&P 500 index. That's pretty humbling. Now, there are stories, of course, where hedge funds just crushed it, 85% gains, which is incredible. But as I said before, that can't be every year, and it's not every year. All right, so let's talk about the passive investing side. So this is when you buy something, like a index fund like VOO or VTI, where you're kind of buying this broad index. There's not a bunch of buying and selling and trading going on. You just own those companies or those assets and you hold them for the long term. Now, if there is a fund manager, that person is really simply rebalancing the mix of things in that portfolio at some interval each year, but it is not some picking and buying and choosing like on the active side. Now, Jack Bogle, who is the founder of Vanguard, this is what he preached his whole life. And there's a lot of amazing videos of him sharing his wisdom and conviction on why this is the best approach. There's one famous quote that says, instead of trying to find a needle in a haystack, just buy the haystack. And basically he means, don't try to find a winning stock, buy every stock. Literally go buy VTI and own the entire US market. And Warren Buffett is a big proponent of this as well, as we've discussed in past videos. He thinks that the average investor should just buy the S&P 500, that they do very well. He also plans to put much of his wealth when he passes away into that S&P 500 index, as opposed to some actively managed option. And so if we dive into the pros of the passive approach to investing, we have things like there's less risk based on poor timing. We as humans, we can get these things wrong. And so just missing a certain day where the market rallies or buying at the wrong time before it drops, those can have significant impacts on your portfolio. There's also less tax implications from capital gains when you're buying and selling so frequently. Another pro is that actively managed funds typically come with fees, and these fees are much higher than something that's passive. Another pro would be that you're not disrupting the compound effect, right? If you leave your money and it starts compounding and multiplying, you let that magic take place without interruption or interference. And maybe the last part would be that passive investing, if you're able to, can help remove emotion from the equation. That approach would shield you from all the news and all the fluctuation and all the volatility because your plan is so simple, it hasn't changed. And knowing that the data available would say that when you have a long time horizon, when you have a long period of time you're investing, you are going to beat actively managed alternatives 90% of the time. Those are pretty good odds. 90% of the time, you are going to beat people who are doing all that stuff that can cause its own mistakes, stress, and have its own financial implications. All right, but have I personally chosen the active or passive approach? Well, if you've watched this channel, you can kind of gather that I do a little bit of both. And I had planned to really go heavy into index funds with maybe like 5 or 10% of my money in single stocks or riskier assets. That did not happen. I effectively have probably 65, 70% of my money in index funds, but I have a third or so in things like single stocks and Bitcoin. So if we go look at 2021, something like VOO returned about 27%. My portfolio, as you can see here, I think I was around 20%. And so that's not terrible, but when I go back and look at some of the things that I bought, the timing of those things, man, if I would have just put that money into VOO, I would have a lot more money, a lot more compounding. And even in these pullbacks that we're seeing here at the beginning of 2022, I would actually have less risk of exposure to the downside that I believe is still going to fall further. So for that reason, I plan to do a lot more investing actually into VTI. That's Vanguard's total stock market index fund. I'm going to put most of my money there. I have so much in these other single stocks with a lot of innovation and tech names, things like Coinbase, things like Square, things like Luminar, which I'll do a video about. These are 5-10 year bets. And I have enough in them that if they start to really go, that's going to pay off significantly. And so with that in mind, I don't think I'm going to add to those. I think I'm going to keep adding to my indexes and see how 2022 goes. So that is it. Hey, if this was helpful, let me know. What are you? In the comments, please tell me, are you a passive or active investor? And most importantly, how did it go for you in 2021? All right, we'll be back with a new video here next week. Please like and subscribe. I will see you all then. Thanks so much.